Brilliant. Well, thanks very much. My name is Nick Purves. I along with a colleague called Ian Lance, have been looking after the Temple Bar Investment Trust since the back end of 2020, November 2020. And as you can see, the performance has been very good since then in a little over 3 years that we've been looking after the trust. You know, as we all know, you need a little bit of luck in this game, and we took on the investment trust, as many of you will recall, about a week before Pfizer announced the efficacy of their vaccine, and of course that prompted a return of confidence to the market and a significant rally in a number of the value names that we hold. We like to think, however, that as you extend time horizons, and this here is we call it our representative fund. This is the client in our stable, which we've looked after for the longest period of time. You can see it's around 23 years. We like to think that as you extend time horizons, the element of luck reduces. And again, as you can see, that we've been able to add significant value for this particular client and a number of other clients that we look after. That in itself is not interesting, of course. I suppose what's interesting perhaps is we've adopted the same value-driven style throughout that 23-year period. And it's, you know, our style of investing is simply to hold what we believe are reasonable businesses, trading at low valuations, sometimes extremely low valuations, and I'll come on to talk a bit more about that in a minute. But companies which are essentially suffering from neglect because the crowd is looking elsewhere, is looking perhaps for more excitement in other parts of the market. And we think, you know, neglect is alive and well in the UK equity market, and I'm going to talk a bit more about that. This chart here, we're just trying to really, I suppose, remind investors that if history is any guide, and we do think it's a guide, a good guide, the greatest or the best determinant of future investment return is starting valuation. And we think that is aptly demonstrated by this chart here. This chart looks at the US market. It spans a long time period, almost 100 years. You can see that on the top right there, 1928 to 2023. Very broadly, the x-axis along the bottom is a measure of market valuation. It's called non-financial market capitalization to gross value added. That's just a fancy way of saying market capitalization to GDP. It's sometimes called the Buffett valuation measure. And obviously high valuation on the right, and then low starting valuation on the left. And then each blue dot represents a subsequent 12-year annual total return that you've achieved from the S&P, and of course that's on the y-axis or the vertical axis. And what you can see is a terrifically powerful negative or inverse correlation between starting valuation and subsequent investment return. Slightly disarmingly, you can see a little arrow at the bottom right there, which shows the valuation today, and therefore tells you that if history is a good guide, you should be expecting from the US market over the next 12 years, 10, 12 years, to be seeing annual negative nominal total return. So obviously that's quite a sobering thought. But the message we really want to ram home is that, you know, it's the good old fashioned message, which is, you know, if you buy high, you should expect to receive relatively poor returns. If you buy low, when valuations are low, you should expect to see good returns. When thinking about low valuations, it's interesting to think about, you know, the context of the UK market. The UK market, as you can see on the left here, is sitting at a very significant discount to MSCI, global and European peers. This is again a composite valuation measures, looks at a mixture of price to earnings, price to book value, and price to dividend. And these things are difficult to measure. But if this chart is anywhere near correct, it suggests that discount today stands at between 40 and 50%. The black line, the horizontal black line, is the 50-year average or so, which is about minus 20%, and tells you that because probably of the sector composition, because in the UK we have some quite capital-intensive industries which earn lower returns on capital, those companies should command a lower valuation. But even within the context of that, the valuation discount today seems pretty extreme. And just in case you're thinking it is just about sector composition, you can look at the individual sectors of the market and how they stack up versus their international peers on the right there. And you can see that pretty much every sector stands at quite a significant discount. What's striking to us is that, you might hear the argument that perhaps the US is a much more dynamic economy. The UK has certainly got its fair share of economic problems, as have other companies in Europe, by the way. And we would buy that argument, except that even when you look at international companies, if you compare a company like Shell to a company like Exxon, they're very similar businesses operating in similar regimes, in similar countries, with similar dynamics and similar risks. And yet, in the case of Shell, it stands on a price-earnings ratio between 7 and 8, and Exxon stands on a price-earnings ratio between 11 and 12. So again, a significant discount, seemingly simply by virtue of the fact that it happens to be listed in the UK. And that makes us exciting, because that's just neglect. That's not the market saying there's anything wrong with the company. That's simply, as I say, gives an indication that investors are just simply looking the other way. These high levels of neglect, as you would expect, are resulting in high, what we call high total return yields. And the total return yield in our minds is the dividend yield and what we call the buyback yield. So that's the yield that shareholders receive as a result of the shrinking number of shares in issue as the company buys back shares. And you can see that the yield in the UK is one of the highest globally, and currently sitting at around 10%. We obviously meet a lot of management teams, and for most industries, not all industries obviously, but for most industries, profitability is pretty good at the current time. Most companies, from an operational perspective, are actually performing quite well, and that's been borne out by the recent results season. A lot of CEOs that we sit in front of seem very unhappy, especially in the UK, about the valuation attached to their shares. And I think our message to them is, don't moan about it, take advantage of it. If your shares are standing at a significant discount and they're very undervalued, then create demand for your own shares by buying back cheap equity, because it's terrifically value enhancing for the equity holders who choose not to sell. And I just want to give here sort of some theoretical examples of how high levels of shareholder return can drive some fantastic investment returns. And I suppose one has to just take one step back and just remind yourself about the three components of return. There's your free cash flow yield. It's the amount of cash that the company generates each year after the requirements of the business itself. So that's all the cash that can be returned to shareholders. there's growth in those cash flows over time. If, maybe the company operates in a growth industry, obviously that growth in cash flows is a further addition to returns. And then there's a third element of return, which can come from a re-rating. So if your shares start out as being lowly rated and the rating increases over time, that further drives upward movement in the share price. A company with no growth on the left that just is sitting on a 10% free cash flow yield, returns half as a dividend, half as a share buyback, delivers a 10%, perhaps obviously 10% return to its shareholders, 5% dividend yield, and then because the number of shares in issue has decreased also by 5%, it means for the same pound note dividend, the dividend has grown 5% next year. So that is a real return. If you add in 5% free cash flow growth, perhaps because the company is investing, your total return becomes around 15%. And then if you get a re-rating, it can be really, really powerful. On the right, we've chosen a re-rating from a 10% yield to a 6% yield. So that'd be a cash PE of just over 15 times. That can drive annual returns of around 25%. So that these levers can be really powerful. And let me try and bring it back to the real world by giving you a couple of historical examples. And we've deliberately entitled the slide "A non-spectacular business delivers its spectacular investment returns," because what we're trying to show here is you don't need high levels of sales growth in order to generate fantastic returns. So Next PLC, you'll be familiar with, the retailer, over the last 23 years or so has delivered sales growth annually of about 5 to 6%. That's a little more than nominal GDP growth. So this is a company which is essentially just grown in line with GDP. It's done a bit more than that in profit before tax, so it's improved margins somewhat. But look at the EPS line. The EPS, the earnings per share, have grown by 12% per annum because the company has been using its cash flows to retire or reduce the number of shares in issue. The shares actually haven't re-rated, so the share price has gone up by about the same level as the EPS, about 12% per annum. You add in the dividend about 3% per annum, you get around 15% per annum total return. 23 years, that's a 2,000% return. Absolutely spectacular return from what you might argue is quite an ordinary business. The case of British American Tobacco, we don't hold this company anymore, but the case of British Tobacco was even more stark. It had no sales growth, but it did improve profit margins. So operating profits grew by about 6%, EPS by about 12%, 13, 14%. The share price here re-rated as the market came to reappraise the cash flows, 18% per annum. Add in your dividend, you get a annual return of over 20%. So here is a company that generated absolutely stellar returns with very little sales growth at all. So it's really, if you think about it, you don't need high levels of sales growth. What you need is good cash generation, a low valuation so that share buybacks are particularly efficacious, and you need a management team who are prepared to deploy those cash flows to the benefit of shareholders. And we would argue that all of those three conditions are in place in the UK today. This is just an example of, again, a real life example. This is actually Dillard's, which is a US department store, so a very dowdy business indeed. Here, over a number of years, the shares in issue declined by about 25%. And then all of a sudden, it seemed as if the market ran out of shares because the share price pops by around 300% in a little over 2 years. So just apologies for all the numbers on this slide. I really want to focus your attention on two columns. Here are 8 holdings, all in the Temple Bar portfolio today. They probably between them make up over 40%, 40 to 50% of the overall portfolio. But the numbers we think, are simply staggering. So the column on the left is the 2-year earnings per share yield. So it takes today's share price of the company and it takes the earnings per share, the earnings that the company has generated over the last 2 years, so in 2022 and 2023, divides it by today's market capitalization to give you a 2-year earnings yield. So BP, for example, has generated over 40% of today's market capitalization in earnings and cash flow over the last 2 years. Just extraordinary. Again, look at some of the other numbers. Look at Stellantis, the auto manufacturer, has generated over 50%. Barclays, almost 50%. These are simply staggering numbers, and these of course are very powerful and enable the company to drive very, very attractive returns indeed. So move your attention to the column entitled 2-year cash shareholder yield. It's the same principle, takes today's share price and then looks at the shareholder returns over the last 2 years, so 2022 and 2023. So obviously that's the dividend paid and the shares retired, or what we call the buyback yield, and adds them together. BP has returned more than 25% of its market capitalization in the last 2 years. NatWest stunningly over 40%. Another 3 years, and your 2 years ago investment in NatWest is completely paid back. And the 2-year buyback return from NatWest, you can see they're 29%. What that tells you is that every pound of profit, the way the maths work is that every pound of profit today generated by NatWest is worth about 40% more to the shareholders than it was just 2 years ago. And these are not theoretical numbers; these are real numbers, and these are very powerful. As I say, it's a mixture of dividends in your pocket and buyback returns, reducing the shares in issue, therefore driving earnings per share growth in future years. And this is all because, in our minds, of the significant level of neglect surrounding the UK market. I suppose I'm just going to finish up before moving on to questions. Going to finish up on this slide, which just shows the top 10 positions in the Temple Bar portfolio. Again, making up about 50% of the portfolio. You can see many of the names we've just talked about represented on this page. And I suppose I would just want to leave you with the notion that there is undoubtedly significant neglect in the UK market at the moment. That is causing or leading to very, very low valuations. And remember, low starting valuations have been the best predictor of good investment returns in the past, and we will think that they will continue to be in the future. Management teams are now driving returns. They have got the message. They are generating cash, and they are using that cash sometimes quite aggressively to drive shareholder returns. And therefore, we think on that basis, the outlook for portfolio returns is extremely good. And at that point, I'm very happy to open up to questions.
Lovely, Nick. Thank you very much indeed. First question is, I've seen a lot of M&A in London, or companies listed in London. Do you see that as a threat or an opportunity?
It's a good. I like the way you phrase that question. It's a good question. It has to be. It depends. It kind of depends which hat you have on. As a shareholder in Temple Bar, it's an opportunity. It's an opportunity because we've had 2 bids in the portfolio in the last 2 weeks, and because the starting valuations are so low, the takeover premiums are tending to be higher. And absolutely, if we get a significant pickup in takeover activity, that of course is only going to be good for Temple Bar shareholders. So absolutely good news from that perspective. If you have a different hat on, and if you're more worried about perhaps the overall health of the UK market, a declining pool of investments, deteriorating liquidity, then it's something that you might feel uncomfortable with. But that's not the hat that we wear. Obviously, we're out to do our very best for our clients. So we think that's a good thing.
Next question, why do you favour Barclays and NatWest over Lloyds in your UK banking strategy?
Do you know what? There's no real reason. I mean, if it was Lloyds in the portfolio as opposed to NatWest, for example, that would be absolutely fine. I think we just have to think about portfolio construction. Whatever investment view you take, there's always a risk that you're wrong. You shouldn't have too much of your portfolio invested in a particular sector, you know, the portfolio is around 20% of financials. It's almost 20% in energy. That's 40% of the portfolio in 2 sectors. That's probably enough.
And next question is about the total size of the portfolio. You have I think the top 10 around 40%, or top 50%. How many companies are there? How many do you own?
About 35.
Further to that, how active is the portfolio? Was it versus a benchmark?
Do you mean level of so active? Very. Active, I mean, we're active as in active positioning. We're not that active when it comes to portfolio turnover. So we couldn't we don't even look at index weights. I mean, because we think totally in absolute return terms. We won't have anything in a sector if we think it's fully or overvalued. You know, that old cliche, you can't eat relative returns, and that's absolutely true, and we try never to forget that.
And a question from me, if I may, you talk about share buybacks, and there was some work on share buybacks versus special dividends. You seem very strongly in favour of the buybacks. If you company management were more favouring the special divvies or increasing the dividend, would you try and influence more towards buybacks?
It all depends on valuation. I suppose there's no one right answer. If the lower the valuation, that's obviously the lower the valuation, the more value you drive by retiring cheap equity. And as the valuation increases, I mean, if your shares, let's pretend, were overvalued, and it's unlikely we would hold them, obviously, if we thought they were overvalued. But if your shares were overvalued, the right thing to do from an economic perspective is to return in the form of a dividend, because you're actually detracting value for the remaining shareholders by buying back overvalued stock. So it's I suppose what we look for in management teams is just be pragmatic. When your share price and valuation is low, tilt towards buybacks. When your valuation is more full, tilt towards special dividends.
And next question, I'm going to combine the two together. Someone's asking, why do you not own BATS, British American, anymore? And the next question is, what's some investments you've removed from your portfolio and why?
So I didn't. Well, let me answer the first question. I didn't quite get the second question, but the first question, we have to believe. There are many companies out there which face challenges. You know, so we invested. You can see we invested in energy and banks. And it's not as if those sectors don't have their challenges. They absolutely do. But we have to believe, rightly or wrongly, that the profit pool of the company is sustainable over the long term. We don't mind cyclicality. We recognise that there are some industries which are cyclical, and you get good times and bad times. But we have to believe that over the long term, the profit pool is sustainable. And I think in the case of tobacco, we worry that it's not, because we can see that just the enormous social pressure that these companies are under through some pretty aggressive now government regulation. The companies are doing perhaps a logical thing, which is to try and move their customers away from tobacco onto what they call next generation products. And good luck to them in that. But you have to be honest with yourself, and those business models the new business models are unproven and unlikely to be anywhere near as profitable as tobacco itself was. And so I think it's a feeling, it's a significant concern that profit pool from the industry is going to decline. It's going to decline over time as tobacco volumes continue to decline.
The other question was, I think you probably covered most of it. Is effectively sell. When do you sell and why do you sell? So as well as cyclicality, I guess there's a valuation point that you actually as well.
Yeah, so we sell when we think the shares are significantly overvalued on our view of what we call normalized earnings or cycle average earnings. And when I say significantly over, we recognize there's a big margin of error in what we do. There's a lot of false precision in our industry, and we recognize that, as I say, the assumptions that we make when we make an investment, there is quite a wide margin of error. So, but when we think something is significantly overpriced and perhaps there's a better opportunity elsewhere, then obviously we will sell it down. The other reason we'll sell it down is if we don't like the actions of the management team. As hopefully what's come across in the presentation I just made is the importance of management doing the right thing, driving value for shareholders, and that really is important. And we don't like it when we think that management aren't doing the right things for shareholders, and we are prepared to exit a position on that basis.
And final question then on management. Do you go out and see everybody? Did you have regular face-to-face or
yes, we do.
Use data models?
Yes, we absolutely do. Yeah.
Okay, lovely. Nick, thank you very much indeed. Thank you very much for joining us tonight.
Pleasure. Okay, thank you. Bye.